Welcome back to AI Analysis 1. Don't forget to like and subscribe. It really helps these videos get out to more people. Let's dive in. Picking stocks can feel overwhelming, but it boils down to a few core principles that balance research, strategy, and your own goals. Here's a straightforward rundown of the basics based on timeless investing wisdom and current market vibes. 1. Define your goals and risk tolerance. Why it matters. Are you aiming for long-term growth, e.g. retirement, short-term gains, e.g. flipping stocks, or steady income, e.g. dividends? Your timeline and how much risk you can stomach shape everything. Example: if you're young and can handle volatility, you might lean toward growth stocks like tech startups. If you're nearing retirement, safer bets like dividend-paying blue chips, think Coca-Cola or Johnson & Johnson, might suit you. Tip: be honest. Can you sleep if your stock drops 20% overnight? 2. Research the company fundamentals, earnings and revenue. Look at quarterly and annual reports found on the company's investor relations page or SEC filings like 10-Ks. Is revenue growing? Are they profitable? Steady growth beats flash-in-the-pan spikes. PE ratio, price to earnings, price divided by earnings per share. A high PE, e.g. 30 plus, might mean the stock's overvalued or expected to grow fast, like Tesla often is. A low PE, e.g. under 15, could signal a bargain or a dud. Debt levels. Check the debt-to-equity ratio, total debt where shareholders' equity. High debt above 1 or 2 can be risky if interest rates climb or cash flow dries up. Dividends. If income's your game, look for consistent payers with a yield, annual dividend or stock price of 2 to 4% and a history of not cutting it. Example: a company like Apple might show solid revenue growth, manageable debt, and a small but growing dividend, making it a balanced pick. 3. Understand the industry and market trends. Big picture: is the sector hot or fading? EVs and AI are buzzing now, while fossil fuels face headwinds. A great company in a dying industry can still sink. Competitive edge. Does the company have a moat? Something brand, patent, scale competitors can't easily copy? Think Amazon's logistics or Nvidia's chip dominance. Tip: skim news or X posts for sentiment, but don't chase hype. Verify with data. 4. Check valuation. Is it a good price? Compare metrics. Beyond PE, look at PS, price to sales, or PB, price to book. A PS under 2 might suggest undervaluation in growth sectors. PB under 1 could mean a stock's dirt cheap relative to assets. Historical norms. Is the stock below its average PE over 5 years? Cheap doesn't always mean good, but it's a starting point. Example: if a stock's trading at $50 with $5 earnings per share, PE of 10, and peers average 20, it might be undervalued unless there's a red flag. 5. Look at technicals, optional timing tool. Price trends. Use charts to spot patterns. Is it near a support level where it tends to bounce or resistance where it stalls? Free tools like TradingView can help. Volume. High trading volume on price jumps signals strong interest. Low volume moves might fizzle. Moving averages. A stock above its 50-day or 200-day moving average might be in an uptrend. Below, maybe wait. Note: technicals matter more for short-term trades than long-term buys. 6. Diversify and manage risk. Spread out. Don't dump all your cash into one stock. A mix of 5 to 10 across sectors, tech, healthcare, energy, cuts risk. Position size. Limit any single stock to 5 to 10% of your portfolio so a flop doesn't wipe you out. Stop losses. Set a floor, e.g. sell if it drops 10% to cap losses, especially if you're new. 7. Start small and learn. Paper trade. Test picks without real money on platforms like Thinkorswim or Webull. Low-cost entry. Look at fractional shares or ETFs, e.g. S&P 500 funds like SPY, to dip in cheap. Example: instead of buying 100 shares of a $200 stock, grab $50 worth and watch it. Practical steps. Screen stocks. Use free tools like FinViz or Yahoo Finance to filter by PE, growth, or dividend yield. Read up. Hit the company's site, earnings calls, or X for unfiltered takes. Just sift through the noise. Start with winners. Blue chip stocks, e.g. Microsoft, Walmart, or index funds are forgiving for beginners. Current context, Feb 2025. Rates are still elevated, Fed funds around 4 to 5% per recent trends, so value stocks, low PE, high dividends might outperform growth. Tech's volatile but rebounding. AI names like Nvidia or Palantir are hot. Energy's steady if oil holds above $70 a barrel. The gist? Pick stocks by knowing what you want, digging into the company's health, and buying at a fair price. It's part science, part gut, and patience beats panic every time. Got a specific stock in mind to analyze? If you've made it this far, I'd like to thank you for your support. It really helps a lot. See you in the next video.